Hello there. Thank you for joining us today. I'm Marcia Butler, the webinar director at Advice Chaser. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box. The presenter will address those queries during or after the webinar today as appropriate. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your phone number as well. If we can't get to your question during the event, we'll make sure that someone reaches out to you after today's webinar. We want this experience to be as educational as possible. So again, please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our presenter today. Let me pop his picture up there. Jeffrey Costa is a portfolio manager and certified financial planner who crafts comprehensive financial plans and investment strategies for his clients. Jeff joined Schultz & Company in 2020. He specializes in holistic financial planning as well as managing his clients' portfolios to meet their short-term and long-term goals. Prior to Schultz & Company, Jeffrey worked at First County Advisors as a trust and investment officer for 4 years, and he began his career in the financial services industry as a financial planner and investment advisor representative at Barnum Financial Group, an office of MetLife in 2009. He has taught on-site financial education in multiple Fortune 500 companies as part of MetLife's Plan Smart program. Jeffrey holds a BA in economics and political science from the University of Connecticut, and he has been a certified financial planner since 2017. Well, Jeff, I know that we've done this before, and I'm glad to have you back. So yes. I'm going to go ahead and turn over the time to you. We've got a lot of interest in this, a big crowd today, so we're hoping for lots of interaction and questions.
Sounds good. Thank you, Marcia, for the introduction, and thank you for having me back. And with that, let's get started. So I wanted to kick off the session today with just a little bit of background on the Secure Act 1.0, just to kind of bring us up to speed on why they decided to come up with a 2.0 and what the original changes were and how that kind of relates to where we are today. So the Secure Act, which stands for setting every community up for retirement enhancement, was passed into law at the end of 2019. And many of the changes were related to IRAs, 401ks, and other retirement plans. There are many, many provisions, like all recent legislation. It's like thousands of pages, but the pertinent issues that are applicable to most retirees are really the abolishment of the stretch IRA for beneficiaries of IRAs and 401ks back in 2020, really, when it became effective. So prior to that, most beneficiaries were able to stretch it over their life expectancy and not have to take out the money in a short period of time, thus reducing taxes and maximizing tax deferral. Secure Act 1.0 essentially made almost all beneficiaries, except for a few exceptions, including spouses, subject to a 10-year rule, which made it so that all money had to be out of the inherited IRA by the end of 10 years. There's a little bit of nuance of the RMD situation, depending on whether the person was taking an RMD at the time they passed away or not. But essentially, all money had to be out by the end of 10 years. That still stands, but they made some other enhancements around the periphery, some of which I would argue are even more meaningful than the original changes. One other major change in Secure 1.0, which has actually just been changed again, was the RMD age requirement. For many, many years, it was 70 and a half, which was always an annoying thing because why the half year? And so they changed it to 72 back in 2019, really effective for 2020. And now we've moved that up again, which you'll see in further slides. So those were really the key takeaways that apply, again, to most individuals. There are, like I said, lots of other nuances that we could spend all day talking about. But let's move into our program for today. So as I mentioned, required minimum distributions have now gotten another change. And starting this year, effective Jan 1, the age increased from 72 for the beginning of RMDs to 73 in 2023. And all the way down the road in 2033, that will move up to 75. And I've heard a lot of people discuss why this was the case and why they're waiting to 2033 to do that. And it sounds like it, in typical Washington, D.C. fashion, had to do with the budget window of how they score the legislation. And so they kicked the can into the next 10-year budget cycle so that it didn't look like they were losing money, as much money in this cycle by pushing out RMDs. So for the next 10 years, it's 73. Starting in 2023, another big change, which has been kind of a thorn in the side of a lot of people, including advisors and their clients, has been the penalty for missing an RMD. People miss RMDs all the time. Typically, it's not on purpose. It happens a lot when people have multiple plans. So because it's aggregated across all plans, if you're not tracking it, or you have one that's maybe self-managed and one through an advisor, if they're not being coordinated, you may ultimately not take as much as you ultimately will need to. So
I had a question here. Can you explain what an RMD is?
Yep, a required minimum distribution, or RMD, is the minimum amount of money that needs to come out of a retirement account. So whether it's a 401k or an IRA, it does not apply to a Roth IRA, and we'll talk about that later. But essentially, the IRS uses a life expectancy table, and they take the balance of the account from the prior year. So 12/31 of 2022, as an example, for this year, they look up your age, you look at the table, it has a certain number that you divide the total balance by, and that gives you your amount. It's in the first year, it's call it around 3.5% or so, I believe. And then each year, as that expectancy goes down, the amount of money typically goes up, assuming your account balance stays about the same or goes up slightly, as we all hope it will. Although for many in 2022, your RMD may have gone down. So blessing in disguise, sort of. And I would prefer to have more money, but so back to the penalty situation. In the past, if you missed an RMD, the IRS would hit you with a 50% penalty for the total amount of money that was supposed to come out. So if you had a $5,000 RMD that you missed, now you have a $2,500 penalty, which is pretty steep, especially the fact that most people don't do it on purpose. And it was definitely a harsh penalty. So starting in 2023, they finally listened. I guess a lot of constituents railed against it to their congressman, and now they've changed it so that it's 25% of the RMD amount. But if you correct it in what they refer to as a timely manner, they didn't quantify that, but I think it's probably within a year or so would be a good working assumption. If you take it out, amend your taxes, and do that, then ultimately it will only be a 10% penalty. So that's a nice change, certainly for the better. And then in 2024, employer Roth accounts will be exempt from RMDs, just as Roth IRAs currently are. It was kind of a weird quirk in that legislation. When Roth 401ks were originally set up and offered, they didn't exempt them even though you've already paid the tax. Because the whole point of the RMD, in theory, is the government wants to get some tax revenue from IRA and 401k accounts that they've let people defer for so many years. They say, okay, well, you got to at least start taking a little bit out, even if you don't need it, because we can't just have everybody defer taxes for 30, 40 years and beyond in some cases. So they said we have to take a little bit. But Roth, you've already paid the tax on the way in because you don't get a tax deduction. So you pay the tax up front, grows tax deferred, and comes out tax free when taken out at the appropriate time and under correct qualifications. So now Roth 401ks, 403bs, et cetera, are subject to that same no RMD requirement. So they're consistent. And then the last change around RMDs is if you happen to have an in-plan annuity, so you purchased an annuity inside of your 401k account, as an example, that now, if you take out a certain amount and it's over the required minimum amount, they'll actually give you a bit of a credit towards the remainder of the account. Because what they do is they take the annuity amount that you had purchased, to say it's 25% of the account, and they take that portion out and segment the two parts of the IRA for RMD calculation. So essentially what they do now is they give you a credit. If you take a whole bunch on one side, they'll give you some credit if it's over a certain threshold. It's a little complicated, and that's something you would want to confirm with your plan sponsors and your accountant to calculate that number, because it can get a little quirky.
Yeah, and we did have a question about that one. So we had one other question that has to do with RMDs. Do you mind answering this one? How would the IRS calculate? I'm sorry, maybe I said it. Oh, I have several accounts to do an RMD for an account.
So really, you should do them. You can do them as a total. So some people, for tax plan or from kind of a record keeping perspective, like to just say, I'm going to do equivalent across my different accounts. But the IRS doesn't really track it from an account by account basis. They really just look at what that aggregate number is, and then they go from there. But it can be a little bit confusing if you do it just from one account, or even just for tracking like at different institutions. Because as an example, if I have a client here and we have a list, from, call it October on, we start monitoring who's taken their RMD or not. And we reach out to those people and we say, hey, you got to take your RMD. If they don't let us know that they've already taken the full amount from somewhere else, then we are freaking out and worried that they're going to get a penalty. So there has to be good communication if you're going to take it all from one place. So I would say that it's, unless you only have a couple accounts and you're self-managing and you kind of really know what's going on, it's probably best practice to take them pro rata across the accounts, just because, again, if you have an account at Schwab or Fidelity, they'll tell you what your RMD amount is, and it'll say you've hit your amount for the year. So this way you can kind of just keep it simple and say, I've satisfied it and there's no problem. But the RMD amount is typically calculated in real time by your institution, because they know what the balance of that account was in the prior year. The only issue is if you transfer accounts from one provider to the next. So if you rolled over your 401k, say January 15th or something after the new year, and so as the new institution doesn't have what that 2022 value is, they can't tell you what your RMD is because they don't have the ability to calculate it. They don't have enough data. So you would need to let them know what that is, but the IRS doesn't go and tell you what it is. That's your responsibility in your financial institution. Again, if you're working with an accountant, they're going to be asking you, okay, well, did you take your RMD? What is it? They'll help you figure it out if you're not sure. But that's not something the IRS proactively reaches out to tell you.
All right, thank you. Lots of good questions there. Let's keep going.
All right, so catch-up contributions. So for individuals that are over 50, they've been able to make extra contributions to their retirement plans for as long as I can remember. I'm not sure when they originally started, but this new legislation is now bumping up the total amount that individuals that are over 60, and for some reason it's 60 to 63. I'm not really sure why it's to 63, and I think I'm personally looking to find out clarification on, is there going to be any further elaboration of, like, if you're 64 and still working, can you not do more than that? It seems very strange to me and arbitrary that you get three, call it 3 or 4 years where you're like, okay, I can do an extra little bit. So I think that probably will get further clarified, but you do get a little extra. So in this year, as an example, if you're in a 401k, 403b, similar plan, $7,500 is the normal catch-up contribution, and now it's $10,000 for those individuals total, above and beyond what the normal 401k, 403b, et cetera, annual contribution limit is, which for 2023 just went up $2,000. It's $22,500 is the total amount you can shelter inside of most qualified plans. And then different from the past, where it was kind of on a one-off basis, it didn't happen every year, but it happened a lot of years. They would bump up the contribution limits similarly to how they bump up the total limits for individuals, not just people over 50, all individuals, not people just over 50. That will now be indexed for inflation on a consistent basis. So that $10,000 annually to a workplace plan, which you see on the slide, that will actually likely be higher than $10,000 by the time it's 2025, because they'll have been indexed up for a couple of years.
Can you talk about what the catch-up contributions are for last year? And I'm assuming until tax time you can do catch-up contributions, and then for last year, and then also can you talk about this year?
Sure. So for workplace plans, employer-sponsored plans that are payroll deducted, those contributions have to be made during the calendar year. So you can't go back now, say in February, and say, oh, I want to fill up my bucket from last year because I didn't max it out. But you can do a catch-up contribution, or make sure you max out your IRA contribution up until the time you file your taxes. The difference too is, like, if you're a business owner who has a SEP IRA, it follows those IRA rules where it's up until tax filing. So it's not calendar year. It doesn't have to be made in the calendar year, but it can be made retroactively for the prior calendar year. You just have to code it and tell your accountant to code it, say this is a 2022 contribution, not a 23, because that's very important for the IRS to kind of keep track of that. But as I mentioned before, catch-up contributions for people over 50, $7,500, and then again it'll go up total to $10,000 in 2025 for over 60 to 63, and then for a traditional IRA or Roth IRA, the base contribution is $6,500, going up from $6,000 last year for individuals under 50. And for everybody else over 50, it's an extra $1,000. So it'll be a total of $7,500.
All right. And that's something that changes, it seems like, from year to year. So in 2023, that's what it is. But if you're watching this recording outside of 2023, just know that this may not be the most accurate data.
Yes, I would say that the catch up for IRAs has been very consistent. It hasn't really changed in a long time. The base amount has changed, but the 1,000 extra really hasn't changed much. So.
All right. Thank you for that.
Okay, I think we can move on. So another change under the Secure 2.0 is related to charitable distributions, and qualified charitable distributions are when people make a charitable distribution from their IRAs, typically. So what happens is, or a 401k, you can get credit for an RMD and the deduction by sending it directly from the retirement plan. And again, this is not something that's done all the time. It's done for individuals who obviously are in the fortunate position where they can donate up to $50,000 a year from their IRA to a designated charity. What the legislation really did was just kind of expand the types of charities that were eligible for these QCDs. So again, this is something where if that's where you're looking to do something and you're in that fortunate position, I would talk to your estate planning attorney and your accountant to make sure that it's the correct type of charity and that you get all the deductions that you expect to do from them. So I'm not going to spend a ton of time on that one. Okay, qualified longevity annuity contracts, or QLACs. So these are annuities that are purchased inside of a qualified plan. So this is when you buy an annuity inside your 401k or 403b. It has to be typically offered through that plan. And the premium limit now went up from $145,000 in 2022 with a limit of no more than 25% of the retirement account balance. They've eliminated that 25% threshold, and they've moved it to $200,000 a year of purchase payment. And a qualified longevity annuity contract is a little bit different than just a normal annuity in that it's for people who are trying to safeguard against really outliving their money when they're 80, 85, 90, and so on. So these contracts are purchased with the expectation that you're likely not going to start drawing on these funds until later on in retirement. And they also help lower your RMD amount pro rata. So if you buy 25% of your IRA account, or I'm sorry, your 401k account into a QLAC, that 25% is no longer subject to the RMD. So it reduces your tax burden on the remainder of the money. It drops down the eligible bucket. The caveat to kind of when you have to start taking income from this, because once you start taking income, just like pulling money from a 401k, you have to start paying income tax at that time. You can't defer income past 85. So at 85, you have to turn on some income from this account. So essentially, if you buy a QLAC, your RMD now gets pushed out to 85 at the latest. I mean, a lot of people may not wait that long if they want to start getting income before then. And one of the benefits to doing this could be that you'll get a higher payout amount on that dollar figure, because the way annuities work, they take life expectancy and they say, okay, well, if we expect that at age 85, you probably have call it a 5 to 10 year life expectancy. And depending on whether it's a joint life annuity or so on, you're going to get a higher per year payout than if you started at 70, because it's just, an actuarial function. So this is a way for people to just protect against outliving their money and perhaps having a bit of a pay raise down the road when inflation starts to bite. So it could be a good option. But there are some advisors who say, well, if you just manage the money in a prudent fashion, you could probably do the same, if not better, with more flexibility and lower fees. So, it really has to be for the right person. But these are just the rules around it. This is not a recommendation or, a positive or negative, just kind of an overview. Okay, so matching in Roth accounts. So if you have an employer plan at the moment, you may or may not be fortunate enough to contribute to a Roth 401k as part of that plan. Not all employers offer it at this point. A lot of them do now, as it's become more prevalent. Younger employees tend to utilize it more because they're not getting as much of a tax deduction now. So in the earlier years, they'll do that. And for those individuals who are putting all their money into a Roth 401k and not getting a tax deduction today, but getting tax-free money in retirement, it was kind of annoying for them because they were getting all of their contributions into the Roth, but employers were not doing that. There wasn't really a mechanism to do that. And so now the IRS said, okay, well, now you can offer matching into the Roth. And the way that works is that the employer still gets the deduction on the way in. So from the employer standpoint, there's really no change, which is nice because the employer obviously wants to get as many deductions as they can possibly have. But now the employee will get that income from the match reported on their income tax, documents, their W-2. It'll show up as reported ordinary income. So they'll have perhaps higher compensation than they would otherwise in years prior, where they were getting a match into the pre-tax side. So there are pros and cons, but again, if you're in a lower tax rate, or you just say, I'd rather just pay the tax now and never have to pay it again, then you can do that and just pay the tax today. But that's something that not all employers are going to offer right away. That's something where if you're interested, you may want to talk to your employer. And we'll talk about a couple other features that will likely make employers have to set up a Roth option if they haven't already. And so they'll be even more prevalent in the next few years. So, automatic enrollment. There have been many, many studies talking about how automatic enrollment has made a huge difference in people saving for retirement. Oops, excuse me one second. The lights in my office just decided that it couldn't see me. So there we go. Anyway, moving on. So the IRS and a lot of other advocacy groups have been pushing to have automatic enrollment be mandatory for new retirement plans. So starting in 2025, all new 401k and 403b plans must automatically enroll eligible employees. So you can go in and then say, I'm not going to contribute, but you have to go in and actually make that election. The default election will be a contribution of 3%. You can always increase it or decrease it, but they figure if the employee is pushed to do it, they're more likely to continue doing it going forward. And all the studies have proven that out. So just a way to help the underfunded retirement of Americans get a little bit better over time.
And the question here, this is for new plans. What about old plans? Are they going to be held to this as well?
So they are not. And that's, again, something maybe that will change in the future. But a lot of these new rules only apply going forward. But that being said, I think a lot of companies have already started doing a lot of this anyway. It may not be at a full 3%, but they may put you in at 1%. Or, HR departments I know are pretty good about advocating that, especially if there's a company match, letting people know, hey, sign up and do it. If you're not going to do anything beyond, just do what the company matches, because it's free money that you're missing out on. So, and one other quick thing to note on that, there are a few exemptions from the automatic enrollment rule. So as an example, 10 or fewer employee companies are exempt from having to do this. But again, a lot of them may want to. Their plan sponsors may say, hey, this is good practice. And unless there's a really good reason, I doubt that they would probably not do it, but they don't have to. Okay, automatic portability. So automatic portability helps particularly younger or perhaps lower income earning employees not lose the money that they have saved up into their plans over a period of, could be a couple years, could be even be a summer job. I mean, as a perfect example, I lifeguarded when I was young, and they had a lifeguard retirement plan, and I think I had a whopping few $100s in this plan from when I was like 16 years old. And at some point in the future, they just cut me a check. Came out of nowhere, they took the tax out, and I was like, okay, great. Well, I don't really need this money, and now I have a small tax bill, and I just spent it probably in the week I got it. But the whole point of this particular rule is to avoid plans that automatically used to cash out balances below a certain dollar figure and send a check directly to the employee, which did what I did and just paid the tax and spent it, because those people will now never get those prior tax years deferral and compound interest over that period, tax deferred and so on. They were losing the real benefit. And so if people were job changing every few years and maybe didn't have a ton in the plan, they could have collectively over a few year period saved $5,000-$10,000, maybe a little bit more, but they only had maybe a few thousand in each plan. So each time it just automatically triggered that plan to cash it out, because the employers don't want to deal with the record keeping on a $2,000 plan or $2,000 employee plan. So they just had rules in it that said, okay, if it's below this, cash it out. And they didn't give you an option. Well, now when an employee leaves, they have to either roll it to an IRA or they have to help facilitate a transfer to the employee's new plan. So it should help people quite a bit, again, particularly that population that's been kind of dealing with this for a long time. So it encourages people to save and not lose that tax deferral, which is a huge benefit. Okay. All right. So an interesting piece of the Secure 2.0 is that now in 2024, student loan repayments could actually be viewed by an employer as putting money into a plan for purposes of matching. So a lot of people who are coming out of school these days have a pretty sizable student loan debt, and they're paying, multiple hundreds, if not thousands of dollars a year, a month to that debt. And that kind of crowds out their ability to save into their retirement plan. Well, what this does is say, well, we recognize that and know that people would save if they could, but they're trying to pay down these exorbitant student loans at high interest rates, which is the prudent thing to do. And now it gives the companies the ability to kind of say, well, okay, well, if you're doing that, show us proof of what you're doing, and then we can credit that essentially towards what would have been a matching contribution. So your $1,000 in student loan debt, we'll do $1,000 into your 401k because we know you're not just spending it silly, and you're doing the right thing, and eventually you'll be able to contribute for real. So I think that's a really good positive change inside this legislation.
All right, and the percentage depends on the employer, correct?
Correct. So it's all going to function just like any other employer match. If everybody else in the company gets a 3% match, and you would also get that 3% match if you hit the applicable 3% of your salary going into a student loan. Again, it sounds like it will be up to the company's discretion to some. So this is kind of allowing them to do it, but not mandating that they do it.
I'm assuming this.
But I think it will be something that, as a kind of a workplace benefit, I think a lot of companies will probably tout that they do that to help attract talent in the future.
I'm assuming that's going to be a little bit of a.
It's going to be
a little bit of clerical work.
It's going to be not easy, and who knows how well it gets put into place. I think it'll take some time to figure that out, but I think this is kind of just like laying the groundwork to say this is something that you can do, because in the past it wasn't really. There's a lot of strange rules inside ERISA, which is the kind of old legislation that mandates how retirement plans can and can't operate. So this kind of helps kind of bulldoze any red flags or red tape, if you will, from making employers worried about doing something like that.
I had another good question here. Is this for only new or young employees? What if you're older and you have student loans? Will that be eligible?
It does not discriminate by age. So at this point, it appears to be any debt. I mean, people that go back to school and get a new degree. I mean, I don't see a reason why anybody would want to discriminate against that and say it's only 22-year-olds. Okay, 529 plans. So for everybody who has the pleasure of saving for a very large college bill in the near future, this one is kind of a nice change where if you have the very fortunate pleasure of having a child that gets a scholarship, or you don't use all the funds that you've saved, after 15 years, the government will now allow you to convert up to that 35,000 over a lifetime, subject to annual contribution limits. they can roll that into a Roth IRA for the beneficiary. So you can essentially help your child or other beneficiary jumpstart their retirement and into a Roth, which is great. So just as a reminder, 529 plans, when the money goes in, you don't get a federal tax deduction, you only get a state tax deduction. So when you think about it that way, it isn't so different than the way a Roth IRA is treated to begin with, as far as paying the tax on the way in. So it kind of makes sense that they would do this. You know, the caveat, like I said, it's a 35,000 cap over the lifetime. That could change, that could get indexed up. But say you had, you know, you saved $500,000 across a couple different 529s, you have a couple kids. If you don't use it all, you could always transfer to a different beneficiary. You could go up to that $35,000 cap. You know, child one, they, you know, all of our kids are out. Child one, we start converting over a period of time. They get their $35,000 Roth IRA. The next kid, it could either be used for education, or you could give them a $35,000 Roth. And if you run out of kids to give Roths to, then you could always change the beneficiary and use it, you know, because 529s, the bennies can be changed. You could use it towards a grandchild or a favorite nephew or whoever you might like, enough to give money to, which is kind of a cool thing that they've done there. But one other thing to denote is where you see the annual limit. If you were to convert 529 funds for that individual up to the limits, let's say for $6,500 in this year, that person would not be able to also make another contribution of that amount. You can't double it up. So that's the total they would get into any Roth for that year, or any IRA for that matter, because Roths and traditional IRAs count against each other. You can't double up on that. Okay. All right. And the last piece, which again is, I think, very smart of, which I don't say that often, but very smart of the government to kind of identify this issue, is that people tend to tap their retirement plans all the time for not even high amounts, but just for small emergencies. Like a lot of people in this country can't afford, you know, if they blow a tire, or they're, you know, they have a big car bill, or their furnace blows up and they need to replace something. Not everybody has a big emergency fund, and most people save the bulk of their money in retirement plans. And so that money, while getting tax deferral and have a lot of other benefits, is handcuffed unless you qualify for a fairly strict set of hardship withdrawals. And so this really tries to mitigate some of that issue where people are taking loans or early withdrawals where they have to pay a 10% penalty and income tax on the money coming out. So they give people now up to $2,500 annually, but that's what the government says you could do. Employer may choose to make that threshold lower for whatever reason, maybe because administratively they don't want to deal with really tiny, certain dollar amounts, or they don't want people, encouraging certain things. But the first 4 withdrawals in a given year would be tax-free and penalty-free if used for, just can be used for emergencies. And it also would be eligible for an employer match. So if you put it into that kind of component, they have an emergency Roth savings account. So again, it wouldn't be pre-tax. It'd be kind of delineated from other parts of the account. They'll say, okay, this is the emergency Roth portion. You've already paid tax on it. You can only put up to $2,500, but if you need to tap it, it's there for you, and we'll still give you credit for the match. So it is a nice way of helping people when they might need it the most, and without, again, hitting them with a really big tax burden on top of the emergency that they already have. And it's not a loan, because loan rates can be fairly steep, especially in a rising interest rate environment right now. But that loan rate is certainly not going to be a 2% loan at this stage.
We had a question here about the emergency savings. Is that for, those are right now for person's only earning an income, what about for current retirees?
Well, so this is all going forward. So this is it would have to be new money going in, and that's starting in 2024. So that wouldn't apply to people who are already retired. This is only people who have, like, starting in 2024, who've designated they're putting money into this particular type of account, and their employer allows that. And I see another question there about what the threshold is for non-highly compensated.
Yeah, we were just talking about that.
Yeah, we were going to get to that, so you beat us to the punch there. So for 2023, it's $150,000 for an employee, or if you are a 5% owner of the business, and that 5% ownership is a little bit vague. It can include ownership stakes by close family members as well. But for the purposes of most people, it's $150,000 qualifies you as a non-highly compensated employee.
You mean a highly compensated employee?
Yes, correct.
That, yeah. All right. Let's go ahead and open up to questions. We've already had several, so I have a few more to throw at you here, Jeff.
All right, we'll do our best.
Yeah, absolutely.
And for some reason it's not an easy question, or we like that we can answer like quickly or right this second. We will certainly, like as Marcia said, be happy to get back to you with the answer.
All right. So when it was talking about matching for education payments, is this match in addition to like standard matching to a retirement account?
No, this would be just if you were not able to get your normal match because you're not able to contribute, this would allow you to get that kind of base level match.
Okay, so it's saying in lieu of retirement savings, you're actually paying off debt for a student loan, and the employer sees that and says, oh, okay, well then that counts as working towards your financial future, so you are eligible for the match.
Exactly, that's it, exactly.
Okay, all right, and
well
that
said,
match is
Marcia,
going
well
to well, it's complicated, no wonder we have questions about it. And
again, it's also somewhat vague, and there hasn't been a ton of clarification. These are kind of like what always happens with these types of changes. It takes at least 6 months to a year when people actually start setting them up and working through to say, well, you guys didn't really give us guidance on here. And then the IRS will typically come out with guidance. Similar to when they put the 10-year rule into place, it was very unclear. I attended some different sessions a month after that happened, and a lot of these high-powered estate planning attorneys are like, well, we don't really know, but we think based on past experience, but they'll come out and clarify, and then that's ultimately what happens. So that's my expectation, is that as we work through these and get closer, like in some cases 2024 or 25, then we'll see more info on that.
So a lot of these new rules and new law applies to plans going forward. What about current plans and legacy plans? Is it likely they will shift towards some of these new adjustments as well?
Yes. So obviously the contribution limits affect all existing plans. So that is a key piece. The one item, and that reminds me, on the Roth side of things, is that going forward, when the enhanced 60 and over match kicks in, there is an income threshold for where that money has to go for catch-up contributions for 50 and overs, not just as a. So if you're over, I believe it's 143. It's approximately like 143,000 in current year dollars. All of those those catch-up contributions have to go to the Roth side of the 401k plan. So what that means is that if your company doesn't have a Roth 401k and they have people making over 140 something thousand that want to put money into a catch-up, they're going to have to set up a Roth option. So I think that will definitely push any employers that don't have a Roth component to do that. Perfect example is my firm. We're a small group, and nobody has set that up yet. Well, you better believe that, like, next week, I'm going to tell them, well, guys, you're going to have to do it, because we're going to, the government's basically going to force us anyway. So just might as well do it this year. And we have younger people that may want to do the Roth. And I think conversations like that are going to happen a lot in the next, few months going forward and next year.
Yeah, lots of changes. Here's another question. Anything in the Secure Act 2.0 that affects HSA accounts applied to high deductible health plans?
So I have not seen anything in my reading so far about HSAs, but there might be some nuanced little thing buried somewhere. But as of everything that I've read so far, I have not seen anything. It's really more around retirement. So I have not seen anything there.
All right. Here's another question. So this is a long one, and I'll just go ahead and read it.
I see it here. This may be something where we have to follow up afterwards.
All right. Well, I think that's what we'll do on that one then. And it has to do specifically with a particular plan. So
multi-employer plan.
Yeah. We'll go ahead and talk about that afterwards and get back to you on that one. Another question that we got was, what about if you are a small business owner and you want to set up a plan, maybe for yourself or for maybe you have one or two employees? Is this going to affect you very much, or are there like exceptions for small businesses that have fewer than 10 employees?
So I'm sorry, can you repeat the first part of that? Because I missed.
Yeah, so I'm just asking, if you're a small business and say you're a sole proprietor and maybe you only have a couple of employees, what are kind of those guidelines on there for really smaller businesses?
Regarding which piece? Because just like automatic enrollment or some of those, because we mentioned that they would be exempt from that. But I think it's really the type of plan. So if you're in a 401k, and then the matching rules and all those should likely apply. I think if you are a business owner who is designing a new plan, you really, really, like always, even pre-Secure Act, you need to make sure that you have a good employee survey of kind of number of employees, how many highly compensated or non-highly compensated, what the goal of the plan is, how much, what the salaries are, all that stuff. You need to talk with a plan consultant to really design the best plan for you, because it really, really has to be customized. There's so many different options. We could spend hours talking about it, and quite frankly, it's all in flux right now. They made some changes with multi-employer plans. We had talked about in the past, and so I would urge you to really reach out to some of the people that design the 401k, 403b. SEP IRAs are a lot simpler, and those really, if you're a small company that only has a couple employees, or maybe even just one employee, that's probably your best bet, because you're going to be able to kind of have a lot more flexibility on how much you contribute. You can do it after the tax year, up until you file taxes. You may not be subject to some of these other mandates that cover 401ks, et cetera.
Yeah, definitely a question for your financial advisor and your plan professional.
Yeah, it's a little too granular for today, unfortunately.
All right. Is it possible to briefly speak of the new requirements of employers to implement dual eligibility for 1,000 hours versus 3-year 500 hours? Do you know much about that?
I don't know a ton about that. I've read a little bit, but again, I'm not specializing in the setup of new plans so much. So that's something I would definitely reach out to the folks that are the plan sponsors or plan, setting up new plans.
Yeah.
That's one of those things where, again, it's an ERISA guideline where you have to make sure that you hit those certain criteria and not, make it discriminatory for all those employees.
Well, we have one more question that we can get to today, and so I'm going to go ahead and read this one, and then we'll close things out. Are the rules different for contractual workers who set up their own IRAs and Roth IRAs, or people who set it up for themselves since their employer does not have, and I'm assuming does not have, a company retirement plan?
Well, so if you have an IRA, you just follow, even if you're a self-employed individual or a contractual worker who's just using IRAs, I mean, it's pretty straightforward. You can just go by any of the normal traditional or Roth IRA rules. A lot of these changes that I talked about today are really focused more on like qualified company sponsored plans. So if you are doing something where it's an individual retirement account, Roth IRA, that's pretty straightforward. It's really just following those normal rules. So you don't have any special situations.
All right. Well, thank you so much for that clarification. It's always nice to get some clarification after new laws are passed, because
yes,
that could be difficult.
There's still a lot to unpack here, and again, these things have like thousands of pages, and they're still being worked out because some of them are vague, and sometimes they cut and paste language from an old document, and then somebody realizes that it doesn't really make sense, and they have to go back and issue a clarification. So
that can happen. Well, I want to thank everyone for being here, and thank Jeff and the organizations that have made this webinar possible today. Thank you so much for attending. To our attendees, look for an email soon with a link to the replay of this event. And you're welcome to share that replay with your friends and family. We're getting several thank yous and well done.
Thank you, everybody.
Chat.
I appreciate it. Thanks for attending today.
Absolutely. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners is committed to offer a free initial consultation to anyone that we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thank you so much for coming. We'll see you at another webinar soon. Goodbye, everyone.